The topic for today is equity. Any guess as to what this is?
Equity is fairness, ensuring that everyone has the resources required to succeed.
Not in finance. Equity refers to ownership of a company. The term is often used interchangeably with stocks. Any guess as to what these are?
A stock is inventory or supplies that a firm or other organization keeps available at any given moment to use in selling or creating its products.
Not quite. While equity is a broader term referring to corporate ownership, a stock is ownership of a fraction of a company. When a company is created, it issues a certain number of shares, each representing a fraction of the firm. So if the firm has 100 shares and you own 5, you effectively own 5% of the company's equity. This means that you have 5% of the voting rights and you are entitled to 5% of any dividends that are issued in the future. Do you know what a dividend is?
The dividend is a number being divided by another, or the numerator of fraction.
Ah, that is correct for math, but not for finance. When companies make profit, the money left from the revenue after they have paid their expenses, they can do two things. They can either reinvest the money in the firm to help it expand, or they can pay some of the profits back to shareholders. These are dividends. When you buy a stock, you are buying a fraction of the company's future dividends. On top of this, stocks can also make you money through capital gains. This is when you sell an asset for a higher price than you bought it for. If you buy a stock at $10, but you find someone who is willing to buy it from you for $15, you have made a $5 capital gain.
So, in your last video, when the private equity firm made the questionable decision of buying 75 shares of that last entrepreneur's Square hot dog business, since the firm had 200 shares, if they distributed $1 million in profits, the PE firm would get 75 200ths of that, or $375,000.
Correct. However, most individuals rarely control that much of a company. Let's imagine that I own one share of Apple stock. At the end of 2023, Apple had, that's a big number. At the end of 2023, Apple had 15,509,763,000 shares in total. So if they distribute $4 billion in profit, I would get $4 billion out of $15,509,763,000, which simplifies to 26 cents.
That sounds pretty low.
Well, it depends on the price the stock was bought for. If you paid $2.50 for the stock, and it is paying you 26 cents per year, that corresponds to a very high dividend yield of 10.4%. But if you paid $100 for it, it is a very low rate of 0.26%. That is why the stock price itself matters much less than the amount by which it grows over time, and the percent of it that is paid out as dividends.
I did some research, and apparently Meta, formerly Facebook, just started to issue dividends this year. Why would people buy its stock if it never offered dividends before?
Good question. There are two main types of stocks: value and growth stocks. Value stocks are issued by established firms that have consistent cash flows and pay predictable dividends. In contrast, growth stocks are issued by smaller companies which have the potential to grow very quickly. In these firms, shareholders would prefer that the firm reinvest their profits into expanding the business further, so that they can make even more money in the future. They consequently rarely pay dividends.
So you're saying that the people who bought Facebook years ago wanted it to invest any profits it was earning back into growing its business?
Exactly. Think of their acquisitions of WhatsApp and Instagram, or its recent AI investments. In a way, the fact that it is now offering dividends is a sign that its investors do not think it can continue the stellar growth it has enjoyed until now. If there are fewer amazing projects it can invest in that will pay off, they might as well benefit from dividends now.
And stocks are a risky investment.
Indeed, stocks do not give you guaranteed money. If the company is doing well and pays larger than expected dividends, you will make a very nice return. If the company starts to grow, even if it is not paying dividends, its stock price is likely to rise, so owning the stock could still get you a very nice capital gain. But if the company collapses, you could lose your entire investment. When Silicon Valley Bank collapsed in 2023, its investors would have lost just about all the money that they put into it.
So why would anyone buy stocks instead of holding safer assets like bonds?
Because of their risk, stocks pay on average a higher return than bonds do. So, with the right investments, you can make more money in the long run if you invest in stocks than you could if you invest in bonds. So, what are your key takeaways?
Stocks are ownership of a fraction of a company, and equity refers to company ownership more generally. Stocks can get you money through either dividend payments, capital gains, or both. Growth stocks are small companies that do not pay dividends but are expected to have large capital gains, and value stocks are established companies that pay more regular dividends. And because stocks are risky, they pay on average a higher return than safer assets.
Congratulations! You've just learned the basics of equity.